Hi, I am Soumya Jain. Welcome to Weekly Economic Insights, where we discuss the latest news and updates that affect your personal finances. In today's segments, we'll begin with experts' view on the recent geopolitical tension and market turbulence. Tensions in Bangladesh and China are escalating and impacting the global markets and investor confidence. So, what strategies can investors use to protect their portfolios from the ensuing market volatility? Let's see what our experts think about this. We have Rishit Shah, QPFP and co-founder at Mega Gain with us.
Thank you so much for inviting me on your show. As far as Bangladesh is concerned, the textile industries which has presence in Bangladesh might get impacted a bit. But overall, as far as the markets are concerned across the world, I don't foresee to get corrected much, or they might get corrected a bit, because Bangladesh is a too small GDP for global markets to get impacted. Yeah, unless and until there's a major crisis which is happening over there. As far as China is concerned, China is one of the largest economies of the world. So any problems arising over there will have knee-jerk reaction across the world. But again, there can be volatility which might see for some time. But again, we have seen in past that whenever there is a global crisis or there is a war which happens, there is a volatility which we see approximately for 6 to 8 months. Then markets start considering that news, and we have seen in past that the markets turning around. So all in all, if I say about the global markets, we might see certain volatilities for a certain amount of time, but in the long run looks good. But at the same time, I'll say in case of any problems which happens in China, right now companies are following China plus one approach. So emerging countries like India can get benefit out of it. As far as how we should structure our portfolios, I'll say there will be 3 types of investors which might see. One is an investor who is having a goal or investment which has an horizon for more than 6 to 8 years time. So this kind of investor has to continue their investment as it is. They don't need to change anything unless and until they have a different risk appetite altogether. Then there'll be a second investor who has a risk appetite, who has goals which are coming in next 3 to 5 years time. So ideally, they should shift their small and mid-cap portfolio to a scheme which is a debt and equity mix, like multi-asset fund or a balance advantage fund or a equity hybrid fund. And for the investors who has a goal which is approaching next 1 or 2 years, they should start moving out of equity and come to a debt portion or non-related to equity assets, because equity can be very volatile in the short term and it can be very unpredictable. So all in all, if I say the investors who has good risk appetite and who has a larger risk horizon, I'd rather suggest them to increase their investment, because we might see good amount of volatility in the coming future. Volatility will help you to get a lower NAV at a lower price share, which will help you in the future for your wealth creation. And for the people who cannot take that much of volatility, start going out of small and mid caps and start moving to an asset which has a mixture of that equity gold altogether. So yeah, that's all about from my side. Thank you.
Thank you for sharing your insights. Now let's talk about Japanese yen's market rally. The Japanese yen has shown a remarkable rally, appreciating 10% against the US dollar in just over 3 weeks. This sharp rise was driven by the Bank of Japan's recent interest rate hike and its plan to gradually reduce bond purchases. The Japanese yen has surged in value recently, causing worries about a popular investment strategy. This strategy involved borrowing cheap yen to invest in other more profitable assets. Now that the yen is stronger, these investments are losing money, forcing investors to sell. This selling has dragged down the Asian stock markets. This has resulted in significant sell-offs in Asian markets, with Japan's Nikkei tumbling nearly 13% and other regional indices plunging over 8%. While the direct impact on Indian investors may be limited, the ripple effect of the carry trade unwind could indirectly influence global investment strategies and personal finance decisions. Let's now discuss an important development in EPFO. EPFO has introduced new standards operating procedures for correcting the personal details of EPF members. These revised guidelines categorizes changes as major and minor, with varying requirements for documentary proof. This move aims to enhance the process of updating members' profiles while preventing impersonation and identity theft. The new rules mandate a more rigorous due diligence process, ensuring the accuracy and integrity of EPF account information. These changes can positively impact employees' ability to maintain accurate retirement account details. This in turn can improve their long-term financial planning, as EPF remains a crucial component of most individuals' retirement savings. The EPFO's focus on enhancing transparency and security in the account correction process demonstrates its commitment to safeguarding the interest of over 7 crore EPF members across the country. Now let's explore a significant tax relief measure for property owners. To relieve homeowners, the government is set to amend the Finance Bill 2024 to restore the indexation benefit of property acquired before July 23, 2024. This change will allow taxpayers to choose between the new tax regime with a lower rate but no indexation and the old regime with a higher rate but indexation benefits. The government has given a new option to choose between 12.5% tax without indexation or 20% with indexation for properties bought before July 23, 2024. This amendment reverses the earlier proposal to withdraw the indexation benefits, which investors and the real estate industry has criticized. The restoration of this benefit is expected to significantly benefit homeowners by reducing their tax liabilities on property sales. Let's discuss SEBI's latest regulatory measure targeting the mutual fund industry. SEBI has issued new regulation for asset management companies to prevent market abuse, including front-running and fraudulent transactions. These rules mandate AMCs to develop sophisticated surveillance systems, internal control procedures, and escalation processes to identify and address potential misconduct. This initiative by SEBI aims to enhance transparency and integrity within the mutual fund industry. By strengthening the mechanism to block market manipulation, the regulator hopes to boost investor confidence in the fairness and reliability of the mutual fund ecosystem. These measures could positively impact individual investors' investment decisions. With increased regulatory oversight and accountability, mutual fund investors may feel more assured about the safety and security of their investments, potentially leading to greater participation in this important asset class. Let's take a closer look at the record-breaking ITR filings. In a remarkable achievement, over 7.28 crores income tax returns were filed for assessment year 24 to 25. Marking a 7.5% increase from the previous year. Notably, 72% of taxpayers opted for the new tax regime, while 28% stayed with the old tax regime. The e-filing portal handled unprecedented traffic with 69.92 lakh ITRs filed on July 31st alone. First-time filers reached 58.57 lakh, indicating a widening tax base. The department's effort in educating taxpayers and streamlining the filing processes contributed to this success. Over 6.21 crore ITRs have been e-verified, with 43.34% already processed by July 31st. The department expressed gratitude to tax professionals and taxpayers for their compliance. Lastly, moving on to a contrasting development on the insurance GST. Finance Minister Nirmala Sitharaman has rejected demands to scrap the 18% GST on health and life insurance premiums. Despite protests from opposition parties and appeals from Union Minister Nitin Gadkari, Sitharaman emphasized that this tax came before the GST regime. She clarified that half of the total rupees 24,529 crore collected from health insurance in the last 3 years went directly to states as SGST. Additionally, 41% of the centre's share is devolved back to states. Sitharaman highlighted the constitutional mandate of the GST Council in making decisions regarding GST rates, pointing out that representatives from all states and union territories participate in these discussions. This stance maintains the current tax structure on insurance premiums, potentially impacting consumer decision on health coverage. That's a wrap for this week's Economic Insights. We have explored major shifts across various sectors, reminding us just how dynamic the financial landscape can be. Stay informed to navigate these changes and make informed decisions about your financial future.